Hello, everybody. Thanks for sticking with us, because this is, frankly, the best panel of the conference. And it's going to be wonderfully moderated by myself, and we're going to have tons of insight from everybody here. The reason why I say it's one of the best panels of the conference is because it's a subject I find fascinating. I think you guys will also. It's the idea of the algorithmic hedge fund. Now, this is a big trend in the world of investing right now. Quant hedge funds, as they're called, have grown at a far greater clip than the broader hedge fund industry over the past few years, whilst the rest of the industry seems to be slowly deflating and closing and struggling and complaining all the time. Trust me, I hear the complaints. But this is broader than, frankly, just hedge funds as well. The idea that we are going to have a more scientific approach to managing money using more technology, more data, is spreading across the entire investment industry. I guarantee you that all your pension funds have now traditional boring mutual funds and asset managers buying alternative data hand over fist and using most of their trades algorithmically. JP Morgan recently calculated that quant funds of some various stripes or another actually account for 60% of all trades in the US stock market. And only 10% is done by a traditional human, the kind of the stock picker of yore. So we're going to be diving into this. The first guy I want to ask is Jonathan about this, because you worked on the hedge fund side as well before coming over to Quantopian. What's been driving this push towards more algorithmic and scientific approach to investing?
Thanks, Robin. So there are a number of factors that can explain this growth. Some are structural, just in the world. So the growth of cloud-based technology, for example, makes all of this opportunity available. But what's also happening is that tools, and not just tools, but really opportunity, which was once the sole province of a very narrow set of organizations, typically on the island of Manhattan or in Connecticut, are now available to the world. So at Quantopian, for example, we've created a free online platform, tool chain for quantitative research and quantitative strategy production, which 5-6 years ago would only be available to some of the largest traditional asset managers in the world. And we've taken that and we've placed that for free on the internet. So we've taken the tool set, which was once available to very few, and we've made that available to the world. And along with that, we've made the opportunity to apply quantitative insights to finance available to the world.
Andy, you've also, sticking on this more democratized approach to investing, you've invested in Numerai, a sort of similar internet-based open platform for sort of DIY quants around the world. Why did you do this? This is a bit of a departure for you guys, right?
Well, it is. It's a departure. It's a little incongruous to think of a venture fund investing in a hedge fund. However, Numerai is it's a community business. It's a community of 17,000 data scientists who are building models, and we're good at understanding community businesses. The business model of Numerai happens to be a hedge fund, trading an ensemble model that the data scientists are creating. So it's a combination that is fueled by some of the trends you said, cloud technologies, really powerful computing that allows more people to build models. And Numerai is open, well, it's open to anyone. I'm sure some people here are members of it. I'm a member of it. Anyone can create a model. You don't have to know anything about quantitative finance. There are lots of biologists that are on the platform as well.
Bit of basic data science helps, though, right?
All you need to know is data scientist.
Yes, exactly. So I think of it almost like a Kaggle for a hedge fund come Quaggle, a Kaggle.
Yeah, in an anonymous manner, though.
Yeah,
also.
Exactly. Christina, one thing, you work, it's quite an unusual model. It's a low latency, it's a high frequency trading hedge fund that operates at great speed. And that's an interesting model, but I'd be interested in hearing how far do you think we're going to go towards a path of having truly algorithmic, systematic hedge funds, and what are the limits? Like, where do we still need humans?
That's a really good question. So I think in order to look at how far computers can go, maybe we can take a look at for an example would be like an area where computers are really good. So for instance, there's AlphaGo, which a lot of people know about, beating the best Go players in the world, the best human Go players in the world, right? Why is AlphaGo so good is because Go is one of the oldest games in the world. It's thousands of years old. There's thousands or millions of games to train upon for this algorithm, and there's millions and billions of data points, really, that it can look at, and that's why it's better than a human. But if you look at areas like, I'm trying to think of one area, for us, even in high-frequency trading, sure, the reason why we do that is because we also have billions upon billions of data points to look at, and that's why we know that relying on a machine actually is better than doing whatever, relying on our human emotions and intuitions. But that is not to say that there is a limit to that, of course. So one limit I can think of actually is in the venture capital space, surprisingly. So if you look at what a VC does, every VC has a different set of rules, right? Go is a game where the rules are pretty straightforward. For thousands of years, it's been the same set of rules. Look at the VC world. Every VC has a different set of rules. When we're talking to VCs, some people stay far away from us, and then there's other VCs who love us. And so you never know. Right, so the rules are different, and also you've probably made, maybe you have a portfolio of some VCs, on average, maybe make a couple dozen investments. So there's not a lot of data points to train upon, and so if there's a lack of data, and if the rules are different between different firms, then that's when you're going to need a human to be there. Another example, we actually went through an audit recently, and that was a giant nightmare. I mean, we had hundreds of email threads, and
well, it hasn't been like one of those 20-year audits that Trump goes through. Right?
Yeah, exactly, right. Hundreds of phone calls and email threads, and this is all manual, and I just saw the CB Insights thing. They had a couple audit firms that are coming up that are trying to disrupt that space, which is awesome. I hope they do, but it's going to be maybe a couple years before that actually takes place. So those are just some examples I could think of.
I'm happy to think you believe my job is safe. I'm less optimistic.
Yeah. Well, Arnon made that point, didn't he? That all VCs think their jobs are undisruptible.
Yes.
But reality.
Yeah, but we have to, because we're human beings. At the same time, my firm at least is trying to profit off of our demise through investments like Numerai. We have investments in another company called Circle Up, which uses quantitative techniques to invest in consumer products companies. The idea there being that consumer products companies all have the same business model. They sell something to a consumer, and a consumer buys it. Therefore, you can normalize the data. So I'm less optimistic that the trends you're talking about will not be applied to venture. I think they will be applied to everything. I just think the technology and the science is getting so good, and it's getting better, and it's accelerating, that it will spread everywhere.
Yeah, I mean, Jonathan, you're Quantopian CIO. You're the sort of the human interface. I mean, are you basically working to make yourself unemployed? Unemployable, even?
Well, first, I would say we have a community of 140,000 people on 180 countries. In our investment process, we're sourcing fully automated strategies, but those automated strategies come from somewhere. They come from the idea generation and the work of all of these individuals. So we're tapping into this global mind share to make something valuable for our investors. And internally, everything that we do, we seek to be based on a process and based on scientific reasoning. So as we move forward, internal data that we continue to grow about the different strategies that we have, strategies we select, strategies that we deploy. We follow, in some sense, a hybrid approach to our investment process, but we're always looking to bring machine-based approaches to everything.
But, I mean, just to follow up on Christina's point as well, what are the limits here? I mean, AlphaGo is a great example because it's so unimaginably complex. But it's a game with clearly defined rules. And one thing I love about markets is because they're a messy, constantly evolving, chaotic system with no rules. And there's so many different agents that act differently and irrationally and with human biases. Can a quant hedge fund really, over time, always do well in an environment that's still so human and still so messy?
Well, I think we've seen that historically. If you look at the hedge fund performance over the last 20 years, the history of the industry, quant funds, by and large, have been the superior performers consistently. It might not be as transparent as some other industries, and a lot of these funds are privately held or they're closed to outside investing. But as you get to know the industry, it's not something new this year that quantitative investing or trading is beating out the human counterparts.
Also, one of the biggest misconceptions in this space is that everyone thinks that, we just have one strategy that we run constantly over the years, and it just is always successful.
Which would be great.
Which would be awesome, but that's definitely not true. Even at the biggest quant funds out there, what we've seen is, they'll they're constantly evolving and shifting their strategies based on whatever's happening out in the markets. And some strategies have a lifespan of weeks, and it could just be dead in a week, and then you got to move on and continue generating ideas and generating insights.
Yeah, I mean, I've heard people call it alpha decay, that something that makes money in a short period of time sometimes lasts for a few days, a few weeks, a few months, a few years sometimes, but it's pretty rare. How often do you guys iterate your models or change or add new signals or new trading algorithms?
Oh, all the time. All the time, yeah. It's a constant process of iteration, and how can we do better? Even if we're doing good enough, okay, can we do even better than that? And just seeing what the limit is of what we can do.
Yeah, I absolutely concur with that. I mean, that's a foundational principle of our organization, which is that all strategies, whether they're discretionary or systematic, they always face competitive pressures and they don't last forever. So how do you bring to bear the greatest urgency and the greatest amount of idea generation? You bring to bear the internet to the problem, and that's really what our business is about.
So Numerai takes a very different approach, and its approach is that when you have humans involve bias, and strategies will inherently involve bias. So how can you reduce or remove bias from investment decisions? And the proposition for that fund is you make it a math problem. And so the data scientists for Numerai actually don't know you download a series of integers, and you create a model. You actually don't know what those integers represent because it's encrypted. In fact, no one knows what it represents. And so the theory there, if it's true, is can you achieve superior returns or consistent returns over a long period of time by removing human bias? And the way you do that, the theory is by making it a math problem. And the way to build the best model, if you make it a math problem, is to have as many people building models as possible and then build an ensemble model on top of that. And the way you do that is to create the right incentive structure to do that. And one way is to make sure that people are anonymous so that they can submit their models from anywhere. I'm not saying that's right or not. We don't know. But it's a different approach.
Yeah. One thing that fascinates me, because it's, anything quant is really hot these days. And like I said, I mean, I talk to so many big, old, boring mutual fund managers also moving into this space and hiring as many data scientists as they're able to get their hands on, really. What happens when everybody's doing this? I mean, for example, with this alpha decay, are you noticing this happening quicker? Because at the back of the day, when markets were far less efficient than they are today, the far slower Renaissance could run some fairly simple trading strategies that would consistently make money. All I hear now is getting more and more brutal, that more and more money flowing into quant will eventually sow the seeds of either just people doing badly or some epic disaster at some point.
Yeah, definitely it's gotten much more competitive, even over the last 2-3 years compared to when we first started off. And what's happened recently is it's not that the industry is dying, which there's a lot of news articles out there saying HFT is dead, it's permanently gone, and that's not true. What's happening is we are seeing a lot of larger firms that are consolidating. They're starting to differentiate their businesses, and they're realizing that you can't just go out into every single market and trade every single thing. That's not a practical business model here. Why don't we focus on the areas that we do best? And so we've seen a lot of that too, and for us also, we focus on the niche areas that we're good at, and that's the only reason we're alive today, actually. Yeah.
So what kind of speeds are we talking about? What kind of holding periods? How long do you typically hold a position?
So we process data at the nanosecond resolution, and in terms of speeds, we can trade a couple microseconds in terms of holding period, and up to a couple minutes sometimes. And but this is I'm saying this it's not like that's our edge. No. Everybody does this in our space, in the high frequency space. So maybe 100, 200 firms out there that do that as well, and that's the area that the microscopic level that we're playing in.
In the slightly slower trading side, do you worry at all that there's so much money going into this space now that there's just going to be crowding and a lot of these signals are going to be harder and fainter to find?
Oh, I certainly expect they'll be harder and fainter to find, but we're set up to capitalize on that environment. I can imagine a world where if you're a hedge fund and you do not have access to a massive global research capability, that it would be very, very difficult for you to continue to innovate, continue to find new signals, continue to process the avalanche of data that's coming your way.
But maybe the end game is there's just one fund that left.
Well, this is why I saw a friend of mine, Matt Levine, wrote about one perfect capital allocating robot that just sits there and perfectly allocates capital to companies around the world.
Right.
That's a great idea.
I mean, that's unlikely because that fund has to trade with somebody else.
Yeah.
So, you know, there is a marketplace here.
But we're starting to see signs that, like I said, I feel that even everybody uses algorithms now. There's no kind of stock, there's no paper being traded. It's all electronic now anyways. I feel like even talking about algorithmic investing sometimes gets a bit redundant. But at what point do things start feeding on themselves and eating themselves? That there are enough trading algorithms operating out in the wild, interacting in ways that we can't foresee, and that causes glitches. And we saw things like the flash crash, you know, sometimes the big sell order by big, boring mutual fund interacts with people in your world and all hell breaks loose. I mean, that should logically be happening more as more money goes into more quant strategies, right?
Yeah, absolutely. You know, that's definitely a possibility, but at the same time, you know, I guess just from our perspective, what we're seeing is we're seeing a lot more democratization of the space, which actually makes it easier for, you know, when we were starting up, it was really hard. This was like 5 years ago, by the way. It was extremely difficult back then to start up a quant or HFT hedge fund. But today, if you start it up, you know, if you want data, you know, there's so many sources of data out there that just weren't available back then. There's so many new sources of different things that you could use for your strategies that, you know, we had never even thought about back then because it wasn't available to us. And so definitely, I think the opportunities it's actually, you know, becoming more opportunities, even though, sure, the marketplace has been relatively the same, but in terms of the ideas you can have and the, you know, types of transactions you can have even, that's all constantly changing over time, for sure.
I wouldn't agree, though, that the ascendancy of quantitative investing, you know, implies there's greater systematic risk in the markets. I mean, I would take the opposite view. You know, it's really kind of the human conflict between greed and fear and, you know, poor incentive structures historically that have led to, you know, manias and crashes. So quantitative strategies are very attractive because, you know, they're testable. You know, risk management is encoded, you know, in the process. You know, you remove the emotional aspect that can cause human bias. You know, in our organization, you know, we marry that with, you know, full trader oversight. So although our infrastructure runs in a fully automated way, you know, we have a very, very experienced, professionalized trading staff, you know, that oversees, you know, the systems in real time, you know, and is able to act, you know, should anything ever, you know, seem questionable.
Yeah, no, obviously humans are doing really dumb stuff with markets a long time before computers came around. But Andy, I mean, one thing that Christina mentioned that, you know, it was harder 5 years ago. One thing I've also noticed a bit of a inflection point in the willingness of people like you and institutional investors to actually give money to young computer scientists. I mean, before the way to hedge fund heaven was to be a star prop trader at Morgan Stanley, Goldman Sachs, and you went out and you did that and you raised a fund. And these days, if you've they don't technically have prop traders anymore, but that's a lot harder. But it does seem to be far more willingness, like, hey, you're a cool person who's got a bit of a background in machine learning, you've got an interesting idea, I'll try and support that somehow. There seems to be more willingness now.
I think, but that's a trend that has been in the macro or, you know, the innovation market for 20 years. It's just starting to be applied to different areas, right? And that's why we as a venture fund would participate in alternative financing, even though we have no business in doing it. We're seeing characteristics of it. These are software companies, right? Or even Quantopian is like, as, you know, software and community as part of what they do, you know? And so, you know, VCs should be investing in that, or you may want to take money from VCs. So I think that's what it is. It's kind of that collapsing. That's happening in many different markets. This is no different than any other. I think at the same time that we, from the venture side, participate in, you know, increased computing power and capabilities of technology, and that's the other trend that's affecting this as well, and that we're trying to think about and process, which is that the machines are getting smarter. They just are. They're not, and I don't see a scenario where that stops. I only see a scenario where that accelerates, and so there are lots of new businesses and challenges that will come from it, but this just is a reality.
What do you think are the challenges, though? I mean, if costs of data, storage.
No, I mean, I view the challenges as a little more of kind cosmic level, right? Which is, the Turing test, right? Right? So any computer that, that can pass the Turing test is smart enough to know to fail it, right? Because it would. And so, and that's like a joke, but it's not really, right? When you have computers doing lots of different things, creative things and intelligent things, how is that going to affect different industries? How it's going to, in finance in particular for today, but other industries, and the implications of that are pretty profound. I don't think we understand them by any means whatsoever, but it is happening.
So like 10 years ago, for instance, if you try to start a hedge fund 10, 20 years ago, what do? You just have a strategy, you plug it into a computer, and you're all set, and you can have a decent hedge fund going. But today, if you try to start a hedge fund, there's no way that's going to happen. You're going to need millions of operating capital. You need to develop, like we developed our own order management system, our own data feed handlers. We developed everything in-house because 5 years ago, that wasn't available. And that wasn't, I'm sure a lot of you guys I've talked to many people here who work at companies that provide data, that provide feed handlers or provide different parts of the pipeline that we would need. But anyway, the point I'm trying to get at is that we need venture capital. We need the financing from firms like that in order to succeed. And so that's why, like Quantopian raised a Series C earlier this year or last year. Yeah, in November. And we were, quietly also raising a Series C at the same time. And back then you would never expect a hedge fund to be raising venture capital. That made no sense. But today that's becoming more and more of a reality because of how technologically intensive these businesses are.
So an interesting parallel or even contrast to that is, excuse me, in the crypto assets world where you can actually bootstrap a hedge fund. Excuse me, you don't need capital to start. You literally need a generic Apple computer, Dell computer, nothing, no particular software, and you could run a hedge fund in the crypto asset world.
But Jonathan, you've had a long career in sort of the traditional hedge fund industry before you went to Quantopian. So why has the sort of investing industry been slower? I mean, I think all industries, look, I'm a journalist. We're incredibly slow and conservative and boring in a lot of areas. It's still hard to get some journalists to use Excel. But why is the finance industry, where it has a lot of money, a lot of brain power, a lot of prestige, being slower to adopt a different model? And what has been now interesting here, what the biggest change or what the biggest aha moment you had from going from the old world to the new?
Well, I think it's basic human anchoring bias. So, these large organizations, that exist for 20 years, they've done very well. They've been doing something for a long time, and they've been successful. It's become less successful so now, but still historically it's been successful. So it's very, very difficult for somebody to completely change their mode of business that's really elevated them to a stratospheric level of income or wealth. So you really need new entrants to the space to do that. So like you mentioned, for the last 10 years I've worked in the traditional hedge fund business, and I've observed a number of trends, and observed that the opportunity to find alpha has become diminished. Not only that, but the ability to find talented people has become much harder. There's some regulatory changes in the industry that's kind of cut off the feeder system from bank prop desks to hedge funds. And when I learned of Quantopian, it was kind of took me 10 microseconds to come to the conclusion that that business model that that firm was growing into was really the evolution of the hedge fund space.
I actually disagree with you. So I actually think that the change has come extremely quickly in the financial industry. You look at like 5 years ago when Flash Boys came out, everyone's like, whoa, this high frequency trading is so cool. And now it's like the lamest thing ever. It's like all old news, and firms are consolidating, et cetera. But I think one of the reasons that I can come up with in terms of why is actually because of the millennials. If you look at these days, like my nieces and nephews are taking computer science class in like elementary school, and so what's going to happen is we have more control, at least for us. I feel like the millennial generation, we have more, what do you call it? We want more control over our investments and where our money goes. Thus we have like, brokers. We have the, kind of people democratizing trading. We have all these different companies coming up, yeah, maybe that could be one of the reasons why. Like, I think I feel more safe putting my money into, a company that uses the techniques that I learned when I was in school. Analysis techniques out there that have been democratized that I learned, back when I was in school, rather than, I wouldn't feel as safe putting my money with an analyst who uses like PE ratios to guess whether or not, Google will go up or down tomorrow, right? I think that's kind of the old school thing now, actually. So. Quant is already becoming mainstream, and I think in the next couple of years it will be. So.
So anybody thinking of doing a CFA, what do you say to them?
Oh, I mean, we don't even hire people with that. Yeah, like,
sorry, guys. Yeah.
Or like MBAs, like it's just the value is no longer. Maybe in consulting, sure, if you're doing things like that, but for the trading world, definitely, it's all about, these days, if you want to enter finance, you study math, you don't study finance.
I mean, one thing that we've done is, we've created a full educational curriculum, free to the world on our site. So you can come and know very little about finance or algorithmic trading, or even computer programming. And, we have over 50 lectures now, which you can take self-paced, in our environment, which, will take you from, very, very basic knowledge all the way up to the point where you can actually develop your own strategy on our platform.
Mm. But I mean, just quickly, we're running a little bit short of time, but interesting hearing broad level, where are we heading over the next 10 years? Because for me, one of the reasons why I find this really exciting, because I think there's really interesting, important stuff going on today, but what really gives me goosebumps is thinking, what does the world of investing look like in 10 years' time, and how does that actually affect markets? Because as markets become less human, as it were, that's going to change their reaction function. Maybe they'll be steadier, or maybe they'll be more volatile, I don't know. But Christina, maybe start with you. I mean, how do you see 10 years' time?
Like I was saying, quant is going to be mainstream. It's going to be kind of the boring mainstream thing. I guess, in other words, the face of the hedge fund industry is going to be people who look like me, which is kind of different. And today, people still aren't used to that, but I think you'll see 10 years down the road, you're going to find millennials who, run these billion-dollar hedge funds, and it won't be as shocking as it is today, perhaps. So.
Yeah, it's a much greater data, greater access, more efficiency in the market. So, steadier markets as markets react, faster to data arrival, and organizations that'll be successful, they'll be concentrated, they'll be large, and they'll have access to tremendous resources that we can, only imagine today. Hmm.
I think it's not inconceivable to think about in 10 years that Quantopian or Numerai could have millions of people, building models for their vehicles, and that feels like an incredibly profound change if that happens. I know that's part of your aspiration, it's part of my aspiration. We don't fully understand the implications of it, but that's a pretty profound change because many of those people will be the millennials. You mentioned math students, kids building models. They can learn data science from your courses and start building models. That's a pretty different world. I don't know what that means. But.
What about VC? Is a robot going to be doing your job in 10 years' time?
We'll see. I think so.
I got a demonstration from a natural language processing program a half a year ago. It was scary. Yeah. It was like, I'm as a journalist. It still can't make bad jokes like I can, though. So that's, we actually have just under 2 minutes left. I thought I'd end there just in case there are any questions. OK, we have one up here. Shout it, yeah.
So you were talking about a model where millions of people are making models, like synchronized stuff. Doesn't that seem unlikely, given how centralized other computers get? Isn't it more likely that we'll have big companies like Google that use supercomputers to make bigger models, and all the little people trying to make machine learning algorithms in their basements are just completely outpaced by that? Because we see Numerai doing this cryptocurrency system where you can wager your bets and bet more on your cryptocurrency. Isn't it likely that we're going to look at the future as to be like Google owns 99% of the Numerai cryptocurrency?
I hope not, because I think the incentive structure that's built into the cryptocurrency, right, incents people to build models and then stake their Numerai on the models, right? The interplay between computers and people there are the creativity and coming up with the idea, the model, and math problem. What you explained could happen, absolutely. But I believe the incentive structure makes it really unlikely. Yeah.
I would add to that you know, in order to train AI to be a kind of super investor, you need to have data. And you know, we as an organization you know, have this ever-growing, very, very unique and privileged data set of hundreds of thousands of independent trading strategies, which really no one else has.
What if Google set up an internal hedge fund? Given the people that work there, given the data that they have, which must be an absolute goldmine to any quant investor.
Do we know they don't have that?
That's a good point.
Probably not, because they're all spending their time on Quantopian.
Yes, exactly. Yeah, well, exactly. Maybe that'll be easier. Any last question? I'll give you one last one. Somebody else, a quick one? OK, well, we'll end it there. Thanks so much for listening to us, and thanks to the panelists.
Thank you.
Thank you.